Hi everyone, welcome to today's video. So on today's video, we are going to discuss a very important topic. Everyone has been speaking that, hey, the market is at an all-time high, it will fall, it can fall anytime, bad things will happen, this, that. Okay, given, that's correct, that market might correct at any stage, no doubt about that. No one knows when it would correct. But no one is discussing why the market would correct. So I will take you through some of the key theories as to why the market might correct. This will help you understand a lot about how to maneuver and how to change your investment strategy. Super important for you to watch this video till the very end. Please watch it entirely, otherwise you would understand half the things, implement half the things, it will lead to bad results. That's one. Second thing, if the market falls, to what level will it fall? So approximately we are at that 18,000 mark. So will it come down to 10,000, 8,000, 5,000, what level, right? This is important for us to understand. And finally, what is it that investors should do right now to prepare for this crash? Now, if you are just a beginner or if you have just entered the stock market and you don't know much, I have created a few small cases. The links are in the description box. Please go and check it out. Very important for you to understand why I have created those stocks. I have made videos previously as to why I have put these different stocks in my small cases. Very important and very simple strategy to invest in today's market. So with that said, let's get the video started and let us first and foremost discuss that, hey, we are sitting at 18,000 Nifty. Will the Nifty fall to 10,000, 8,000, 5,000? To what level will it fall? I'll not give you the answer right now on this section. I'll give the answer somewhere along the video. But here are some key points that you must understand. Point one is that in 2008, when the financial crisis hit, the entire world was in panic because no one knew that, hey, you know what, this 2008 financial crisis, it's originating from the bank. So probably the banks across the globe will just go under and there will be like no banks left whatsoever. So there was massive panic in the market. The crisis originated from the US and it spilled over to across different parts of the world. 2-3 important points to notice here. First and foremost, this was a US made crisis and the spillover effects took place all across the globe. That's one, right? Which shows that the markets across the globe are interconnected. This is going to be super important when we discuss the subsequent section. Point 2. In 2008, markets corrected by up to 60%, 60%, right? So if hypothetically Nifty was trading at approximately 7,000 level, it came down to 3,000 level. So massive tanking of the market. So could such a scenario play out in today's world? I will give you the answer. I will help you understand this point more fundamentally. Now, third and final point is that when the market corrected in 2008, it was a unique situation, right? For example, the 2020 coronavirus crash is a watershed moment. It's a unique situation in the world. We have never witnessed ever in our life such a scenario before. So whenever these completely unfamiliar situations kick in, the market corrects by a lot. Why? Because the markets hate uncertainty, right? Very important point. Keep this in mind also. So with that said, these are 3 points. What level will we correct to? I will discuss the answer subsequently. But let's discuss the second and the more important section for our today's video. That why is it that the market might correct? Now there are essentially 5 reasons that I can think of why the markets might correct, and I will take you through these 5 reasons one by one, and I hope that you would understand why these reasons are prominent. Of course there can be some other reasons also, but as per my understanding, the probability of market correcting because of these 5 key points that I'm going to speak about would be the highest. So the first key point why the markets might correct would be the increasing debt across the world. Now here is a chart for you which shows that how the world debt has been increasing literally every single year, and now it currently stands at $281 trillion. That's the debt that the world has taken. Now you would say, okay, you know what, Akshat, okay, $1 trillion, this, that, we don't really understand. Can you help us contextualize this debt, right? Now here is a very important point that you must understand. It says governments, companies and households raised $24 trillion debt last year to offset the pandemic's economic toll, bringing the global debt total to an all-time high of $281 trillion by the end of 2020. Now we have taken on more debt, or more than 355% of the global GDP. It's like saying that your yearly income is, let's say, 1 lakh, but the total debt on your household is 3.55 lakhs, right? I'll say that again. That yearly, let's assume that you're earning 1 lakh, but the total debt that you have on your head is 3.55 lakhs. You tell me, is this a worrisome sign or not? According to me, this is a very worrisome sign. Why am I saying it? Because there is no respite in terms of debt coming down. World is taking more and more debt. What that means is that either the governments across the globe are going to tax their citizens more and more, because they either tax their citizens higher and higher to repay that debt, or they become more efficient in terms of their spending. Now, hoping that the governments will become more efficient in terms of spending is a fool's dream in my opinion. I don't think governments will become too effective in terms of spending. That has never happened. So that is unlikely to happen. And even from raising a tax perspective, now here is a chart for you about the Indian taxation system and what is the current effective tax rate, the highest current effective tax rate. It stands at approximately 40-43%. So there is very limited scope left for increasing the tax and repaying the debt. This is a very worrisome sign, and at some stage this debt will hit us hard. Now your obvious question would be that, hey Akshat, why is it that the US keeps on increasing more and more and more debt and nothing bad happens to the US? This is a very complex macroeconomic concept to explain, but I'll try to do it in the next few seconds. Actually, what happens is that if you have taken debt in your own home currency, for example, if US takes debt in US currency, if China takes debt in Chinese renminbi, then it does not impact them that much. But if India takes debt in US dollar terms, then India has to be much more frugal in terms of its spending. So countries like India, which take debt in foreign currency and have higher growth prospects, will get hit the most when this debt bubble bursts. So to cut the long story short, the world is taking more and more and more debt. I honestly do not see how governments can become more cost effective and control their spending. Limited avenues to tax people more. This debt bubble is going to burst at some stage. Now, I'm hopeful that the world's growth catches up, that there is more technology innovation, there is a bunch of other good things that might happen. So because of which this debt bubble might not burst. But if we do not improve our growth rate and growth prospects, when I say us, it means the entire world, that we do not improve our growth rate and growth prospects and do not grow massively, this debt is going to hit us hard. Now you might say that, okay, hey Akshat, understand the debt problem, debt is a problem, get it, but people have been taking more and more debt, countries have been taking more and more and more debt, they are just passing on the burden to future generations. So probably this dance will continue to go forever, right? I don't know, it might, right? Who knows? But there is another imminent problem, right? A problem that might take shape literally in the next few months. And that problem brings us to point number 2, which is called as tapering, right? So let me quickly explain what tapering means, because this is a slightly complex macroeconomic concept. So I'll just explain it by taking you to my whiteboard. Now here is an article clipping that I would want you to zoom in and read. So read it closely. It clearly says that the Fed has assets worth 4.7 trillions, which has since increased to 7.8 trillions as of April 14, 2021, right? So basically the US Feds are buying more and more and more bonds, which is leading to quantitative easing. So very heavy macroeconomic words, so do not fret. I will explain it and break down this statement. Okay, so this is what you should know about quantitative easing, right? Quantitative easing. So quantitative easing literally means that you have central banks, right? So you have central banks in India, you have Feds in the US, FEDS, Feds in the US. These are central banks of different countries. Now what they do is that they somehow figure out a way to increase the money supply, right? Money supply in the economy. So for example, if you are taking a look at India, so I'll not draw the map of India, just consider it as a rough drawing, right? So this is India, so to say. Now, if the money circulation, let's say that if there are, let's say that there are $1 trillion that are floating in the Indian economy. Now, a 2020 like pandemic situation hits, then what will happen to this money supply? It will come down or it will go up? It will actually come down. Why? Because people like you and me, what would we start doing? We will start hoarding this money. So many of us would withdraw money from the bank because we will feel that, you know what, Corona like situation, we don't know whether banks will go under. Some bad stuff might happen in the economy. So just like we all hoarded a bunch of dal, chawal and all that stuff, we also hoard cash, right? So this hoarding of cash happens in one way or the other. This might be the case that you're not hoarding cash in physical form at your home, but you might be spending less. So that also leads to hoarding of cash. So this entire money supply takes a hit. Now, if the money is not moving through the economy, what would happen? That all the things will stall. Businesses will stall. Banks will start lending less and less. So someone needs to come up, start bringing more money into the economy. Okay, I also understand that I have very bad drawing skills. I get a lot of comments, so please ignore it. It is just for understanding purposes. Let's move on. Okay. So who does this spending? So it is essentially the central bank. So how do they do it? Essentially what they do is that they buy bonds, right? So they buy bonds, right? There is a bond. They buy bonds and they release cash in the economy. So how do central banks increase the money supply? They do it by buying bonds, right? Bonds means that it's like a certificate which says that, hey, this is the maturity period. It will have different terms, that this bond will mature in 5 years, 7 years, whatever number of years. So central banks are going to buy this bond, and in return, they will release money in the economy, right? So this money supply does not take a hit, so to say, right? Especially during the time of crisis like 2008 or 2020. So I hope this point is clear. This in simple terms means quantitative easing. That central banks are not printing money per se, right? They might be printing a little bit of this money, but majority of the quantitative easing happens by buying bonds and releasing money in this economy, right? So more money is released. That is the central point. Now you would say that, okay, hey Akshat, what is the benefit of releasing more money in the economy? What does that lead to? So essentially what it leads to is that it leads to lowering of the interest rate. Now currently you might be witnessing a narrative that, you know what, go and buy houses because the housing interest rate is very low. Why is the housing interest rate low? Because of this quantitative easing, right? Now because there is more supply of this money in the economy right now, therefore the interest rate comes down. Interest rate means that at what rate you are borrowing. Now I'll not get into the details of how interest rates are decided, all that stuff, but it's fairly intuitive to understand that, hey, if there is more supply of money, money is freely available, so interest rate will be low, right? That's the point that you need to notice. Therefore, interest rates right now are low because banks want you to take more and more loan, okay? So that the economy moves. So I hope this concept of quantitative easing is very clear to you, right? Now, opposite happens. Now, the opposite of quantitative easing is something called as tapering, right? Because you would say that, hey Akshat, these banks are buying bonds after bonds and releasing more and more and more money into the economy. Till what point? Till what point are they going to keep on releasing the money in the economy, right? As I showed you from the article that approximately $8 trillion worth of quantitative easing has already happened. This is excess money that is there in the economy, so to say, right? This money is over and above. Now, this money has been released in the economy to deal with the economic problem that 2020 COVID crisis has created. Now, this excess money needs to be withdrawn from the economy at some stage. Now, that process is called as tapering, right? Tapering. Now, what do Feds do? They actually taper this interest rate, right? They will keep on increasing the interest rate little by little, little by little, little by little, so as to withdraw this excess liquidity. Because as the interest rate go up, what would happen? That people will borrow less, right? So there will be less liquidity in the market. So this tapering phenomena is very important because we understand that, hey, you know what, right now there is asset price inflation that has happened everywhere. Because of what? Because of this increased money supply in the economy. Money is flowing literally everywhere, increasing the prices of literally everything. Now this money needs to be sucked back by the central banks. So that process is called as tapering. And when will this start? Now, according to a recent meeting by the Feds, they are saying that, hey, we will start this tapering somewhere in November of this year and we will continue to do it till next year. And at that stage, this interest rate phenomena and this liquidity phenomena will somewhat stabilize. This is what Feds are saying. Now you would say, Akshat, that okay, you have told us the date, November, that is when the markets are going to fall. No, right? Because these news are already out there, right? This has been factored into the stock market. Everyone knows that the tapering is going to happen. But no one knows the method of how it is going to take place. Now, according to Professor Ashwath Damodaran, this tapering can happen in a very fast and furious way. Right? Fast and furious way. What it simply means is that, for example, if Feds released $8 trillion into the economy, now suddenly they wake up and they say that, you know what, okay, let us withdraw this entire $8 trillion. Now what will happen then? Then the entire money that was flowing into the stock market when this $8 trillion package, so to say, was given, it will come out, right? Then stock prices are moving like this, and from November onward it will fall like this, right? But this is not going to happen because no governments in the world want to shock their stock markets. So this phenomena is unlikely to happen. A more temperate or sensible tapering might be done over time, and that is the reason why Feds have given it a 12-month, 14-month window. Now this tapering will take place slowly. Now you would say, Akshat, then why did you tell this whole story and wasted our time? Okay, now here is the reason why. Because even as per major economists like Dr. Rajan, even macro investors like Ray Dalio, what they say is that, you know what, no one knows how inflation plays out. Now this is like super complex macroeconomics, so I'll not go in there. But through this entire hoopla of doing quantitative easing and then doing tapering, it's not a simple game that, hey, you know what, we will release like $8 trillion, then we will withdraw like $8 trillion, everything will be fine. No, it doesn't work that way because macroeconomics is so complex that even Feds or central banks cannot approximate how it will impact inflation. Will it go up? Will it go down? How will it impact the growth of different nations and bunch of different factors? So we can't say for sure that by the time this tapering ends, what would be the impact on the economy? It might be okay or it might not be okay, we don't know, right? So this could be a potential reason for the markets to correct. Okay, now comes the third reason for the crash, and which is the cryptocurrency market. Now many of you believe that, you know what, crypto is like a pointless asset, it's air, it's fluff, it's this, it's that. Okay, everyone is entitled to their opinion. I'm not belittling that, you might be right. Okay, but here is an important point and a fact that we can't ignore, that just because, let's imagine the worst case scenario that the crypto market completely vanishes, completely goes away. Would that lead to stock market correction? I don't think so. Why? Because currently the crypto market, can you guess what is the valuation of the crypto market in total? What is the market cap of the crypto market, so to say? Guess and write down your answer. Okay, the right answer is $1.6 billion. That's it. Now, question number 2. Can you guess the size of the stock market right now? Guess, write it down. I will read the comments. It's very useful for me to understand that what type of audiences are watching my video, and this becomes like a two-way interaction between us. So do type out your answer. So the right answer for the stock market, total world stock market size is $71 trillion, right? It's like 10,000 times more than the crypto market. The crypto market is very, very small. Even if it vanishes completely, even if it tanks completely, it's not as if that because of crypto market something bad will happen in the stock market. That will not happen. So this is definitely not a reason. But after 10 years, if the crypto market becomes really big, right, and if it has potential influence on the stock market, this could become a potential reason for the market crash. Now the fourth reason and the most probable reason, if I have to bet my money, I'll put my money on this reason. Then the fourth reason why the markets might correct would be China, right? Now you would say that and you will start applauding that, hey, you know what, that the Chinese have destroyed like the health of the entire world. They have been drinking bat soup and, you know, dog soup and whatnot, really bad stuff. And now they are like at it and they will bring down the stock market too. So there is a lot of negative narrative around China, but we need to understand the situation more holistically, what is happening. Now, of course, China is very opaque, very difficult for us to understand everything that is happening in China, but some key points that you must understand. Number 1, the debt on China has been rising. There is no point in looking at the debt numbers in China because the data is not correct. Sometimes they say that, hey, you know what, the debt has come down by 20% each year, this, that. So pointless debate there. But the Chinese domestic debt, that the debt that they have borrowed in other currency is very, very low, right? So whatever debt China has on itself, it can easily manage it because their debt is in its own currency. This is a point that was made by Ray Dalio also. Second point, this is a chart that you need to look at and be worried about. Now this is the China's external debt. This is the debt that they have given other countries. In what currency? In renminbi, right? So this debt has been going up massively. It stands approximately at $5.6 trillion. This is the amount of money that they have lended to countries like Nepal, Sri Lanka, Maldives. They are building like Hambantota port and whatnot. African countries, bunch of African countries. All these countries are indebted to China in an external currency. Okay, that is not their internal currency. These African countries, they are indebted to China in an external currency, in renminbi format. Very important point, I'll not get into the debates of this. Now what this simply means in easy to understand language is that at some point, China will reach out to these countries to collect debt. Now do you really think that China will collect debt in renminbi format? No, they will collect debt in cloud or sovereignty format. What this means is that if China is building some kind of infrastructure in some African country, they are not going to say that, you know what, Nigerian government pays the money. No. They will put Nigeria in a situation where they are not able to repay the debt. Then China will exert some kind of political influence on these countries. What would this lead to? This will lead to a lot of political clash with the US and this will lead to trade wars. Now you would say, Akshat, you have gone mad. You are building some psychopathic theories. It will not pan out. No. Please read this statement. So this was a statement by the US, and the US says that US as the largest shareholder of World Bank has objected to lending to China. David Malpass, the American president of World Bank, has criticized China's lending effort to fund its Belt and Road Infrastructure project, that the loans leave weaker countries with excessive debt and low quality projects, right? So China is lending to these countries with a very specific goal of political expansion. This, according to me, would be one of the reasons why market would crash. Because the debt is going up for a wide range of countries, China is intervening, exerting its political clout, it has political ambitions plan, it has political expansions plan. So this will lead to a lot of clash in the international community, and due to trade embargoes, the growth will stop, and that debt bubble that I have been speaking about on point 1, it will kick in, and that can ruin the show for everyone. Now, fifth and final reason could be a mix of everything, as I was explaining earlier, or it could be a completely unrelated event like North Korea nuking someone, right? Now, of course, there are so many countries that have nuclear weapons with them. We are literally sitting on a brink of another world war. So we should not discount that. There is so much resentment, discontent that is growing in the world, so much negativity that is there, so much competition that has been increasing at the world level. So don't discount the fact that these smaller countries which have nuclear arsenal, they might not retaliate with these big players. It is not easy. In international relations, there is something called as mutually assured destruction, which literally means that if North Korea nukes US will nuke North Korea back and both the countries will get destroyed, right? That is called as MAD, mutually assured destruction. So therefore, countries do not bomb each other. That is the reason why you don't see China nuking US and US nuking China. But that does not mean that we will not reach a Cold War-like situation. There is a high likelihood that we might reach that Cold War-like situation at some stage in the future, and we should be truly worried. So, your next obvious question would be that, okay, Akshat, you promised us that you will tell us to what levels will the market fall. So the answer is not that simple, but I'll bifurcate the answer into 2 points. One, if we are dealing with this debt problem or China problem, etc., then the markets can easily correct up to 50-60% levels, as has happened in the past, because this debt bubble is something that the world has not dealt with yet, ever, right? This is a new crisis in the making, and it will happen in some stage. 10 years, 20 years, we don't know. So the market, if hypothetically speaking, this debt bubble burst next year, and if we are sitting at 20,000, can it fall to 8,000 levels? Yes, it can. Okay. The second scenario could be literally the destruction of the world scenario, that a Cold War-like situation breaks up, international trade stops, and bunch of other negative things happen in the market. What would happen then? Okay, what would happen is that the asset prices everywhere will fall. It is irrelevant whether you are investing in stock markets, fixed deposit, houses, whatever. It does not matter at all, because prices of everything will crash, right? It will be a depression-like situation, 1930s depression that happened in the US, that because of depression, the asset prices stayed low for approximately 1.5 decades, and such a scenario is very well in the making. So what is it that you should be doing? Number one, as a new investor, please do not be scared of making investment in the stock market, because we don't know when this bubble will burst. It might happen after 50 years and you're just sitting on cash waiting for the market to correct to 10,000 levels. And from 18,000 in the next 50 years, if it goes to 100,000, you're still waiting for the market to correct to 10,000 levels. Please don't make that mistake. Keep investing your money. That's one. Second, please understand that if a macroeconomic disaster happens, then everything will go bonkers, right? Everything will take a hit, including the stock markets. Looking at the chart, looking at MACD, looking at candlestick, whatnot, it will not help at all, right? Everything will tank and all your investments will tank with it. But an important holistic point to understand is that everyone along with you will also suffer, right? So it's like the entire class failing the exam. Okay, it will hurt you. Yes, of course, you will feel bad that, hey, I failed. But hey, all my friends also failed. So if you're sadistic, you can take joy in that, right? So the bottom line is that please don't be afraid of making investments. Third and more important point is that you must prepare for this market crash. Okay, what that means is that please stay diversified, check out my small cases, understand why I've made those investments, and figure out your own investment strategy as well. So I hope you enjoyed the video. Please press the like button and I will see you the next time.